Many people think you need 20% when buying a home, but that's actually a myth. The idea comes from when 20% down was the standard, especially for conventional financing. Lenders saw it as a way to reduce risk, and having a big down payment can still help you reduce certain costs. But today, there are plenty of loan options that require much less than 20% down, making homeownership more accessible. In this video, I'm going to discuss the financing options for putting down less than 20%, and we'll actually review the financing scenarios for some of these options in a side-by-side comparison. If you're new here, my name is Tim Kelly. I'm a loan officer right outside of Washington, D.C., and the purpose of this channel is to help you manage your mortgage and finance your real estate goals. Now, let's talk loan options that allow you to put down less than 20%. For instance, FHA allows you to buy a home with as little as 3.5% down, and they're especially popular with first-time home buyers. VA loans, which we covered in how to choose the right loan program, offer zero down for eligible veterans and active duty service members. USDA loans also offer zero down for buyers in certain rural areas. Even conventional loans sometimes only require 3% down, although you will pay for private mortgage insurance or PMI. On the plus side, you'll need much less cash at closing, which will help you get into the home sooner. This is especially helpful if you're qualifying for down payment assistance programs, which we covered in our last video. On the downside, putting down less than 20% requires private mortgage insurance, which can add to your monthly payment. So it's about finding a balance that works for your budget and your financial goals. Private mortgage insurance, or PMI, is a fee that lenders require when you put down less than 20%. There are many ways you can pay for PMI. It can be paid monthly, or a one-time fee paid at closing or financed into your loan. It can even be paid by your lender. PMI protects the lender in case you default on the loan. While it can add to your monthly payment, PMI is not permanent. Once you build enough equity, usually once you have 20% equity in your home, you can ask to remove the PMI. So while PMI can add to your monthly payment or your costs in the short term, it doesn't have to be a deal breaker. It's important to know that putting down less than 20% is common, especially for first-time home buyers. In fact, according to recent studies, most first-time home buyers put far less than 20% down. So if you don't have a large down payment, you are not alone. As I discussed in the How Much House You Can Afford video, the key is to finding a loan option that fits comfortably within your budget. There are many ways to buy a home without requiring a huge upfront down payment. Don't let the 20% myth hold you back from exploring your options.
So let's do that. Let's compare some financing scenarios and show the difference between putting down 20% versus putting down 3% with conventional financing. What I've done is I've created a total cost analysis, and this is the website. You'll see it linked in the description of this video. And we build these for clients that allows them to compare different financing strategies, up to 4 financing strategies per total cost analysis. And what we're doing here is just comparing a 20% down payment to putting down 10, 5, and 3%. Now, when I'm recording this, it is November 8th, and the average 30-year fixed mortgage rate is just under 7% today. So we've created this analysis that allows us to compare 4 different financing strategies. And the first column is representing a $400,000 purchase price with 20% down. You can see here the cash to close is just under $90,000, just over $90,000, and the monthly payment $2,550. Well, if you put down 10%, you'll see the cash to close drops to under $51,000, and your monthly payment goes up to $2,867. Compare that to a 5% down payment, your cash to close drops to $31,000, and your monthly payment over $3,000 a month. And then finally, if you are a first-time home buyer, you can put down 3% with conventional financing, and that's going to drop your cash to close to $23,000 and your monthly payment just over $3,100. Now, one thing about this cash to close that we've reflected here, this includes your down payment plus your closing costs, prepaids, and escrows. It's for a $400,000 property that is based in Virginia. Closing costs can vary depending on where you are buying, so just keep that in mind. Now, you'll see here the difference in the monthly payment. If you put down 3%, your cash to close drops by nearly $70,000, but your monthly payment only goes up by $576 per month versus 5%, $508, and then 10%, $316,000. Your savings over the 3-year period of time that you own this property, if you put down 20%, would be about $19,000. But your estimated net worth 7 years from now, and assuming the home appreciates 4% a year, if you bought the home and you put down 3%, your net worth would increase by $173,000 versus increasing by $235,000 if you put down 20%. So the point with this is, how long is it going to take you to save the $90,000 that you would need if you put down 20% versus buying a home today with 3% down, or however much you feel comfortable with, as long as it fits within your budget, and increasing your net worth through home ownership. When you're buying your first home, it's helpful to think of your home as your first investment. And what I mean by that is, this is your first step in the property ladder. You can use your first home and leverage it to buy your next home, to move up.
And if you found this video helpful, check out some of my other videos. Check them out. You might find them helpful.